When you look at the stock market, it can feel like pure chaos, right? Just this giant, unpredictable ocean of numbers. But for decades, some of the most brilliant minds out there have been on a mission to find the hidden order, to figure out the math and the psychology that makes it all tick. And today, we're going to unpack their incredible theories. Okay, so here's the game plan. We're going to take a trip through more than 50 years of finance. We'll start with the idea that completely changed how we invest. Then we'll ask if you can even beat the market in the first place. After that, we'll see how you can literally put a price tag on risk. And finally, we'll talk about what happens when our very human brains get in the way of all these perfect theories. It's going to be great. All right, let's dive in. Our story kicks off back in the 1950s. Back then, investing was, well, kind of like an art form, not really a science. But one deceptively simple question was about to change absolutely everything. This right here. This was the puzzle that a young economist in Harry Markowitz was wrestling with. See, before him, it was all about finding that one superstar stock. But he thought, is there a smarter, maybe even safer way to play the game? And his answer was modern portfolio theory, or MPT. And honestly, it was a total game changer. The core idea is just genius in its simplicity. Stop trying to just pick stocks and start building portfolios. Because by mixing different assets together, you could actually slash your overall risk without killing your returns. So the real magic of MPT was how it split risk into two different buckets. First, you've got systematic risk. Think of this as the big stuff, a recession, a war, stuff that hits the entire market. You can't really dodge it. But then there's unsystematic risk. This is the stuff that's specific to one company, a bad product launch or a CEO scandal. And this is the risk you can actually do something about. And just look at this. You can see it right here. As you start adding more stocks to your portfolio, that company-specific risk, it just starts to melt away. The theory shows that once you hit about 15 or 20 stocks from different industries, you've pretty much wiped out most of the risk that's within your control. It's pretty amazing. So all of this leads to this really cool concept called the efficient frontier. The best way to think about it is like a menu of perfect portfolios. For any amount of risk you're cool with taking, this curve right here shows you the absolute best return you should expect to get. According to MPT, this is the sweet spot. This is where every rational investor wants to live. But, and this is a really big but, MPT kind of lives in a perfect little bubble. It assumes we're all hyper-rational robots, that the future is just going to be a repeat of the past, and that trading is totally free. Well, we all know the real world isn't quite like that. And these assumptions, they left the door wide open for the next big ideas in finance. Okay, so if MPT taught us how to build a smarter portfolio, the next question was, should we even be trying to pick stocks at all? What if the market is just way, way too smart for us? And that brings us to the efficient market hypothesis, or EMH. This is a huge and, frankly, super controversial idea. It basically says that trying to beat the market is a fool's errand. Why? Because any and all information is already baked into a stock's price, like instantly. The second a piece of news hits, the price adjusts. And that means that any future price moves are totally unpredictable. It's a random walk. Now, EMH isn't a one-size-fits-all thing. It comes in a few different flavors. The weak form says you can't get an edge just by looking at old price charts. Then there's the semi-strong form. This is where most experts think the market actually is, which says all public info, like news reports, is already priced in. And finally, the strong form says even secret insider information is already in the price, which, can't be true or else insider trading wouldn't be illegal. So this is the thing, right? If markets are so perfectly efficient, how do you explain things like the dot-com bubble or huge market crashes? The truth is, people aren't always rational. We follow the herd, we get cocky, and our behavior creates these weird situations that the theory says just shouldn't happen. So while that whole debate was raging, another group of academics was tackling a more down-to-earth problem. They were thinking, okay, we get it. You take on risk. But how much more money should you demand for taking on that risk? They wanted to put a precise number on it. And this quest gave us the Capital Asset Pricing Model, or CAP-M. It's this elegant little formula for figuring out the exact return you should expect for taking a risk. And the secret ingredient, the key part of the whole thing, is a concept called beta. All beta is, really, is a measure of how volatile a stock is compared to the overall market.
Okay, I know, it looks like a scary math equation, but I promise the idea behind it is actually super simple. It's just saying your required return should be whatever you can get on a totally safe investment, like a government bond, plus a little extra bonus for being brave enough to invest in the stock market. And how big that bonus is? Well, that all depends on the stock's beta. And this line right here? This is basically just a picture of that formula. It's the fair deal line. If a potential investment plots above this line, hey, that might be a bargain. You're getting more return than you should for the risk. But if it plots below the line, it's a bad deal, and you should probably walk away. Let's make this real for a second. Let's say a super safe bond pays you 5%, and you expect the whole stock market to return 10%. Now you're looking at a tech stock that's pretty wild. It's 1.5 times more volatile than the market, so its beta is 1.5. CAPM says you should demand, not just hope for, but demand a 12.5% return. If you think it's only going to return 11%, the model says nope, not worth it. But, the real world is a bit messier than just one factor. So in the 1970s, a new model came along called arbitrage pricing theory. It's basically a souped-up version of CAPM. It says, hold on, it's not just about overall market risk. Other big economic things, like surprise changes in inflation or what's happening with industrial production, they affect stock returns too. Now, have you noticed something about all of these theories we've talked about? MPT, EMH, KPM, they all have one giant shared assumption, that we, the investors, are perfectly rational, calculating machines. But we're not, are we? So what happens when we finally throw our hands up and admit that we're all just human? Well, that's where behavioral finance comes into the picture. And it is such a fascinating field. It literally mashes up psychology and economics to figure out why we do the weird, irrational things we do with our money. It's the theory that finally helps explain those market bubbles and crashes that EMH just can't seem to account for. And behavioral finance has found this whole treasure trove of mental shortcuts and biases that constantly trip us up. There's anchoring, where we get totally hung up on the first price we see. There's herding, which is basically just financial FOMO, buying a stock because everyone else is. Overconfidence, where we all think we're the next investing genius. And then there's the big one, loss aversion. This single insight from two psychologists, Kahneman and Tversky, is, well, it's everything. The pain you feel from losing $1 is more than twice as strong as the pleasure you get from gaining $1. Think about that. It explains so much about our weird behavior, like why we'll hold on to a losing stock for way too long, just praying it comes back, all to avoid that sharp pain of admitting we messed up. So we've gone on quite a journey here. We started in the clean, perfect, mathematical world of Markowitz and Cap, and we've ended up in the messy, complicated psychological world of our own minds. So after all that, where in the world does that leave an investor today? It leaves us right in the middle of this huge debate. Do you trust the elegant math of the rational models, or do you lean into the messy reality of behavioral finance and build a portfolio designed to protect you from yourself? The truth is, the best approach probably isn't one or the other. It's both. It's about finding that perfect balance between the flawless model on the spreadsheet and the flawed, emotional human being who has to actually use it.